Ladies and gentlemen, welcome to Asian Guy Analysis on 15th January 2026. Gold and silver are moving in a way markets do not ignore. Prices are climbing to fresh records, even as stocks swing and headlines stay tense. This is not just another short-term spike. Something deeper is happening under the surface. Investors are reacting to uncertainty, not excitement. And when uncertainty rises, money behaves differently. Today, we break down why gold and silver are setting new highs, what is driving this move, and why many investors are still cautious despite the rally. Gold and silver markets are rising in a way few analysts have seen in decades. Both metals are pushing into record territory, with gold near its highest price ever and silver breaking above the 90 per ounce mark for the first time. These moves reflect more than short-term buying or trader momentum. They show that current economic forces and global events are reshaping investor behavior across the world. First, let's look at the data. Spot gold climbed above $4,600 per ounce and has traded close to or at record levels in recent sessions. At the same time, silver has surged past $90 an ounce, marking a historic milestone for the white metal. In many markets, the gains have extended a rally that began in earnest in 2025, when both metals saw some of their strongest yearly performances in decades. On the surface, this looks like a classic safe haven move. Safe haven assets are investments that people buy when they fear economic risks, currency weakness, or geopolitical instability. Gold has long been viewed this way because it does not pay interest or dividends but tends to hold value when other assets falter. Silver shares many of these characteristics, though it also has an important industrial role in technology and clean energy production. Several fresh news items help us understand why this rally is happening now. One key factor is persistently weaker than expected inflation data in the United States. Recent inflation reports showed underlying price increases coming in below market expectations. This kind of data strengthens expectations that the U.S. Federal Reserve will cut interest rates later this year. Lower rates reduce the opportunity cost of holding non-yielding assets like gold and silver. Geopolitical tensions are another major driver. Ongoing protests and unrest in countries like Iran have added to uncertainty in global markets. When powerful nations face political shocks, investors often recalibrate risk appetite, pushing money into precious metals. This behavior was visible in recent sessions, when silver and gold prices jumped in direct response to geopolitical developments. Political dynamics in the United States are also playing a role. Recent discussions and investigations involving top U.S. financial institutions have rattled some investors. Markets do not like uncertainty about institutions that guide monetary policy or economic stability. This uncertainty, even before any policy change is announced, can increase demand for assets viewed as safe and reliable. Beyond macroeconomics and geopolitics, structural factors are highlighting silver's unique position. Silver is used in a wide range of industries, from electronics to solar panels and electric vehicles. This industrial demand has been rising sharply as economies worldwide focus on green energy and technological infrastructure. As production demand grows, supply struggles to keep up, leading to tighter markets and higher prices. The supply side for silver is particularly constrained. Unlike gold, which is primarily an investment and store of value, silver must meet both investment demand and industrial need. Mining output has lagged behind, and above-ground inventories have dropped in many major trading hubs. This imbalance amplifies price moves when investor interest rises, because there's less buffer stock to absorb increased buying. Central banks are also a key piece of the puzzle. Many banks around the world have increased their holdings of gold in recent years. Central bank buying directly supports prices, because it reduces the metal available for other buyers while signaling confidence in gold S-value as a reserve asset. While silver does not benefit from central bank demand to the same degree, broader institutional interest has increased, particularly through exchange-traded funds, ETFs, that allow investors to gain exposure without holding physical metal. Investor psychology matters too. Once prices start to hit historic levels, market behavior can shift into momentum-driven patterns. Traders and funds often chase assets that are already rising, hoping to capture short-term gains. This can create a feedback loop where rising prices attract more buyers, further pushing prices upward. While this effect can boost short-term moves, it can also increase volatility. This brings us to another important element, the weak U.S. dollar environment. Precious metals are priced in dollars, so when the dollar weakens, these assets become cheaper for holders of other currencies. Recent data has shown periods of dollar weakness, reinforcing demand from international investors. A weaker dollar, combined with high uncertainty, often enhances the appeal of gold and silver. In addition, commodity markets are responding to broader trade and supply chain concerns. Export restrictions from major producers, tariff fears, and logistical bottlenecks have created stress in metal markets. For example, export restrictions on certain critical metals have affected global silver availability, making inventories tighter and price movements more sensitive to demand changes. Taken together, these factors explain why gold and silver have extended their rallies into early 2026. Lower inflation and rate cut expectations make safe assets more attractive. Geopolitical stress and political uncertainty increase risk aversion. Structural supply constraints and rising industrial use give silver a dual role as both hedge and commodity. Institutional demand from central banks and ETFs adds another layer of support. And a weaker dollar environment amplifies these effects globally. It is important to note that rising prices do not always mean markets are stable. In fact, record highs can sometimes reflect underlying fear rather than confidence. When investors are uncertain about the economic outlook or worried about financial stability, they may flock to assets like gold and silver, not because they are cheap, but because they are seen as safe havens. In the next section, we will look at how some investors interpret these moves as potential opportunities, while others warn of risks if sentiment shifts sharply. But right now, the data and market behavior show a strong convergence of forces driving precious metals upward in a highly uncertain global environment. Uncertainty is the key factor shaping the current rally in gold and silver. Unlike typical market upswings, driven purely by economic growth or industrial demand, this surge is largely fueled by fear, geopolitical tension, and unclear monetary policy. Investors are not buying these metals because they are cheap. They are buying them because they represent stability in a time of doubt. Let's begin with monetary policy. The U.S. Federal Reserve has played a central role in investor behavior in recent months. Inflation data has been inconsistent, showing periods of cooling but also remaining above the long-term targets in some areas. When inflation is unpredictable, markets struggle to price assets accurately. This uncertainty increases demand for gold and silver, which historically retain value when fiat currencies and bond yields fluctuate. Investors are closely watching potential Fed rate cuts. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold and silver. When rates are high, investors prefer bonds and savings instruments that provide guaranteed returns. But with expectations of rate cuts, precious metals suddenly become more attractive. This dynamic has been a major driver of the rally. Beyond monetary policy, geopolitical events are heavily influencing markets. For example, ongoing tensions in the Middle East, especially political instability in Iran and surrounding regions, have increased global risk perceptions. Disruptions to trade, energy supply, or regional security create uncertainty that markets hate. In such scenarios, gold and silver act as hedges. Investors move funds into these metals as a protective measure against unexpected shocks. Political instability is also not limited to the Middle East. In the United States, recent investigations and policy debates around financial institutions and economic regulation have unnerved investors. Market participants worry that changes or disruptions could affect liquidity, interest rates, or the broader economic outlook. This uncertainty makes safe haven assets like gold and silver more appealing, particularly for institutional investors who manage large portfolios. Another important dimension is global economic uncertainty. While some economies are recovering from the slowdown of the previous years, others face slowing growth, trade tensions, and inflationary pressures. Investors in Europe, Asia, and the Americas are watching these developments closely. Any sign of economic instability abroad influences global markets and reinforces demand for gold and silver. Currency volatility is another factor linked to uncertainty. A weaker U.S. dollar generally supports higher gold and silver prices because these metals become cheaper for holders of other currencies. Recent reports indicate periods of dollar weakness have coincided with spikes in precious metal prices. For investors dealing with multiple currencies, hedging through gold and silver becomes a natural strategy during times of volatility. The psychological factor of uncertainty should not be underestimated. Investors often react more strongly to fear than to opportunity. When headlines are dominated by political conflict, economic warnings, or global instability, market participants tend to make decisions based on perceived risk rather than fundamentals alone. Precious metals provide a way to protect wealth when confidence in other asset classes falters. In addition, market structures amplify the impact of uncertainty. Exchange-traded funds, ETFs, backed by physical gold and silver, allow rapid inflows and outflows, increasing price sensitivity to investor sentiment. When uncertainty spikes, buying pressure through ETFs and other instruments can accelerate, pushing prices higher in a short period of time. Global industrial demand, especially for silver, adds another layer. Unlike gold, which is mostly an investment asset, silver is used extensively in technology, renewable energy, and medical equipment. Supply constraints, such as reduced mining output and lower inventories, mean that when investors seek silver as a hedge, prices react sharply. This dual nature of silver, both an industrial commodity and a safe haven asset, makes it highly sensitive to periods of uncertainty. It is also notable that uncertainty can trigger speculative behavior. Once prices begin rising due to fear-driven buying, momentum traders often enter the market. This creates short-term volatility, but also reinforces the trend as rising prices attract additional buyers. Even when the fundamentals justify the rally, this behavioral component can accelerate gains in the metals. Finally, investor diversification strategies contribute to the trend. Portfolio managers often allocate a portion of assets to gold and silver during times of uncertainty, balancing exposure to equities, bonds, and other riskier investments. This strategic allocation amplifies demand when uncertainty rises globally, and partially explains why the current rally in precious metals is so broad and sustained. In summary, uncertainty is the dominant force behind the ongoing surge in gold and silver. It is driven by mixed inflation data, potential interest rate cuts, geopolitical tension, political instability, currency volatility, and industrial supply constraints. Psychological and structural market factors amplify this movement. Together, these elements create an environment where both metals continue to climb, reflecting not optimism, but cautious demand for safety and stability in unpredictable times. Even as gold and silver surge to record levels, many investors remain cautious. A rally driven by uncertainty and fear is different from one based on steady economic growth. Sharp gains attract attention, but they also carry higher risks, and savvy investors are aware of this. One reason for caution is volatility. Silver, in particular, tends to move faster than gold, both up and down. While rapid price increases can generate short-term profits, they can also lead to sudden pullbacks. Analysts have observed that when metals rise too quickly, some investors sell to book profits, which can trigger temporary corrections. Another concern is momentum-driven buying. During periods of uncertainty, fear of missing out, FOMO, can drive investors to buy metals at elevated prices. While this adds fuel to the rally, it also increases the chance of rapid reversals if market sentiment shifts. Experienced investors distinguish between fundamental demand and speculative buying, often avoiding large positions during peak euphoria. Macroeconomic uncertainty is also a factor. Although weaker inflation and potential rate cuts support metals, unpredictable geopolitical events or unexpected policy changes can reverse trends. Investors know that markets can overreact in either direction, so caution is warranted. Liquidity considerations further reinforce prudence. Large purchases in physical silver or gold require significant capital, and selling during sharp price swings can be challenging. ETFs provide flexibility, but sudden market corrections can still affect portfolios. This is why many professional investors monitor position sizes carefully and avoid overexposure, despite bullish fundamentals. In summary, while gold and silver offer protection during uncertainty, the rapid pace of their current rally encourages caution. Volatility, speculative buying, macroeconomic unpredictability, and liquidity challenges all make measured strategies important. Investors seeking exposure often balance their portfolios, combining metals with other assets to manage risk while participating in the ongoing rally. Looking ahead, gold and silver are likely to remain in focus as long as uncertainty persists. Economic indicators, central bank decisions, and geopolitical developments will continue to influence prices. Investors should expect periods of sharp gains and occasional pullbacks, reflecting both fundamental demand and market sentiment. Interest rate expectations are particularly important. If the U.S. Federal Reserve signals rate cuts, metals may rise further. Conversely, signs of stronger economic growth or unexpected inflation could slow the rally. Investors also need to monitor industrial demand for silver as sectors like renewable energy and electronics continue to expand globally. For now, gold and silver are sending a clear message. The market is cautious. Record prices reflect concern, not celebration. Those holding or investing in precious metals are effectively hedging against uncertainty, while others watch for potential corrections. The metals are both a reflection of fear and a signal of ongoing global volatility. In conclusion, gold and silver are not just assets, they are indicators. Their rise tells a story of a world still navigating economic, political, and industrial challenges. As long as uncertainty remains, these metals will continue to play a central role in global markets.